Singapore, the smallest country in Southeast Asia. But despite its size, it has the highest GDP per capita in the region. The country also has a unique monetary policy not found in most economies. What is it and how does it affect your investments? Stay tuned. And please like and subscribe to our channel if you like videos like these. The Singapore dollar nominal effective exchange rate, also commonly referred to by how it appears to be spelt out, SNEER. It is the basis for Singapore's monetary policy, and it decides how strong the Singapore dollar should be when compared to others. Unlike other countries, the Singapore Central Bank does not set domestic interest rates. Instead, it manages how strong the Singapore dollar should be, and allows the interest rate to be set by the local banks. The SNEER is actually a policy exchange rate between the Singapore dollar and a basket of international currencies that is not disclosed. The strength of the Singapore dollar when compared to this basket is maintained within a band. The slope, width and midpoint of this band is set twice a year, in April and in October. If there is higher global inflation, the slope of this band is set to be more steep, which means the Singapore dollar is allowed to strengthen a little more, so that Singapore is not impacted too much by rising prices of imports. The Singapore Central Bank does this by selling other currencies. And if prices are falling worldwide, the slope is allowed to ease, so that the Singapore dollar can weaken, making its exports more competitive. A widening of the band means that the Singapore Central Bank expects volatility in the foreign currency market, while a lowering or raising of the band's midpoint indicates that the central bank will be making sustained attempts to either weaken or strengthen the Singapore dollar in response to more extreme economic conditions. Every April and October, the Monetary Authority of Singapore will provide guidance on whether they are tightening, widening, or easing the slope of this band. This will give you a clue of how the Singapore dollar and your investments will perform in the next 6 months. If the slope or midpoint of the SNEER is being raised, it means that the Singapore dollar will be strengthened gradually over the next months. This means that industries that rely on exports such as electronics and pharmaceuticals, and the REITs that rent out their spaces to export-oriented tenants, may see more headwinds in the months ahead. But a strong Singapore dollar will also protect consumers from rising prices. This means that industries such as leisure and retail, and REITs that are heavily exposed to these sectors, will experience some tailwinds in the months ahead. Inversely, if the slope or the midpoint of the SNEER is being eased, it means that the Singapore dollar will be allowed to weaken in the coming months. And this means that the prices of imported items will rise more robustly, which would be bad for the retail and hospitality segments. But it could be a reprieve for exporters and manufacturers in the country. In summary, Singapore uses currency strength instead of the interest rate as a basis for its monetary policy, given how the country imports most of its goods. But as a result of this, the dynamics of the Singapore market are a little different when compared to most other markets such as Europe and the US. And besides watching interest rates, it may also be prudent to understand the latest SNEER policy and how it might impact your investments. Do you have any questions on the SNEER? Do leave your questions or comments below, and we will try to be in touch. And drop us a like and subscribe if you found this video to be useful.